Also learned a new phrase that I'm going to see if your kids have taught you, or maybe you picked up from your kids, or to see if you are still a kid, Marcos. Okay.
Okay.
Maybe two words. I want to know if you know what they mean because they were new to me. I had not heard them before. The first
Okay.
one is cap, CAP.
Yeah. Don't cap, kid.
Don't cap. Can you explain to the audience what cap is?
No cap. It's no cap. Don't lie.
No lie, exactly. Well, cap is you're lying, right? No cap is you're not
Yeah, that's
lying.
straight cap. No cap. I'm not lying.
Nice. Okay, you're one for one. Second one, do you know what Riz is? RIZ.
Ooh. No, I was hoping you were gonna go drip.
You got mad Riz. I watched you on that show and you had quite a bit of Riz.
Yeah. So my natural tendency to say something like swag. The father in me wants to throw at you, oh, must be Brazilians, because that's a great quality. Um, but it's
You're,
not.
you're on the path. It's
Riz.
actually short for a word.
I know. That's why I was gonna go Brazilians. Riz is, oh, charismatic.
Bam.
That's what I knew it because my son uses it, dude. I knew it.
Okay.
That's why.
You are hot with the
He'd
youngsters.
be disappointed in me. I thought you were gonna go with drip. You got killer drip right now, BH.
Is that like basketball moves?
No, it's referring to your outfit or your clothing.
Ah, some of that one
Ah,
either.
so good.
Kids, I don't. So I have a reason why I don't know these words.
Yeah, that is very fair. The 16-year-old keeps me up to speed and up to date. You know what I get him with all the time? It's so funny because I do it to him when he's so I'll wake him up and I'll turn on the light and I'll kind of speedily run to his window, look outside. I'll look, he goes, "What is it?" It's out there. For what? Opportunity. And I get them I've done it so often though that it sometimes doesn't work. And the other day, oh man, let me see if I can remember.
So you just use bad dad jokes.
It does, but it's motivational. And he's never gonna forget.
You should say, look, it's the early bird.
Oh, there you go. At 7:21 a.m. on August 29th, I texted him out of nowhere. I saw it this morning. I couldn't believe it. He goes, saw what? And by the way, this kid usually takes 72 hours to reply to a text. He replied 3 minutes later saying, saw what? And I said, opportunity, Charles. Opportunity. And he goes, dang, you got me.
And then he rolled his eyes and said, I will
No,
never use that ever again when I have kids.
so good. So good.
Welcome, boys and girls, episode 42 of Talk Your Chart. Brett Horwitz here with the phenomenal Marco Segura. Today is September 12th, 2023. And today we're going to start on a couple of data points that have come out in the last week that are very interesting, that have gotten the market to be a little surprised. I'm going to start with the personal savings rate, which we have a chart here going back 10 years. And throughout most of the early 2010s, you had a personal saving rate above 5%. It spiked obviously in the pandemic when everyone saved all their money. And now it's coming down and down and down and down. And now it's at a lowly 3.5%, the lowest since last November. This is maybe a good sign that people are using up all of their cash they have the sidelines and the inflation is going to come down. Or you could take the other point. This means, when people stop saving, that means unemployment goes up, people lose their job, and next thing you know, we have a recession. What's your take on this?
My take is it shouldn't be a surprise that it's come down because that's what it does after it spikes to ridiculously augmented all-time highs. This
Right, but what
is,
about the fact that it's down well below its average, right? So down is fine if it's back to like in the fives, but here we're down to like one of the lowest numbers we've had in the last 10 years.
I think what happens after you get above average readings and generally any metric, you get below average readings on that same metric, and that's how you get to an average. And that's why averages can be misleading, perhaps. This has been, so while we're showing this chart, this is probably, who knows, a fifth time we've shown this chart. this has been one of the talking points as to why the recovery will fizzle out, why the markets can't continue their run, why personal consumption, which makes up 75% of US GDP, is not going to be able to do what it usually does because this happens. This also perhaps explains why credit card debt is up, right? Savings is down, credit card balances are up. But I wouldn't be overly worried about something like this. If it continues, sure, it happens, but I think it's generally cyclical. The long-term average, like going back to the 50s, is 8.7%. Okay, that's fine. If you look 5 years around 9.4, 10 years, what you said, around 8.3. So we're well below, but let's watch credit card balances and let's see if the consumer keeps doing what they're doing. Because they're still spending, baby. They're still spending.
Yeah, well, they're not going to be able to spend much longer. So I'm hoping this just brings inflation down nicely and we don't lead to that, as we've talked about so many times, the hard landing versus the soft landing.
So why don't you use this to talk about my chart that I brought? I know I'm interrupting yours. I just think it kind of plays into it. One of the charts I showed here is basically how margins have proved surprisingly resilient this year. Coming into the year, many believe the combo of high inflation and rising rates would lead to significant deterioration of earnings growth and therefore margins. But that just hasn't happened yet. So in this chart I'm putting up here, it's just showing S&P margins on a net and EBIT basis. And while they're down, which is good, right? But to your point of inflation, they're still well below, well above averages. So why is that? People are still spending, but, and I don't know where you stand on the issue of corporately fueled inflation, but they're still raising prices and they're keeping those prices. They have not come down and people are still meeting that demand. So I don't know if we want to get into price elasticity and inelasticity, but but there you have it. Margins look good.
So just to be clear, for those that don't know, EBIT is earnings before interest and taxes. Some people add depreciation, amortization there as well, but it's basically just two ways to look at the earnings of companies, and it's been solid. And so I think this is why the market has done so well this year. And all the doom and gloomers, if you're doom and gloomer, you're just not a good investor, because overall, long-term markets go up. We know that. Long-term companies make money. We know that. And the S&P, especially as we talked about, it is the best of the best companies, right? It's constantly being reevaluated, which companies are in there. And so I think the strongest companies should have that pricing power. If you're weak, you're going to fall out of the S&P 500 or not have that pricing power.
Agree. Another point, interest rates going higher means companies have to take out debt at higher rates, right? Not necessarily, especially when you're talking about the 500 biggest companies in the world, or at least in the US. And then if you go globally, same idea. When those companies take out debt, if you look at the share of the debt outstanding on S&P 500 companies, the share that is long-term in nature over 10 years is now astoundingly higher than that is sub 10 years. So when rates were low in 2020 and 2021, they were taking out 30-year debt.
Right.
And yeah, everyone wants Walmart's 30-year debt. Why? Because insurance companies are very big and need safe returns for a long period of time. So that pressure of having to pay higher interest payments just hasn't hit them at this point. And they have now a lot of runway to be nimble in how they do choose to refinance. And if you are in the camp that a recession is going to start in the fourth quarter of this year or in 2024, more broadly speaking, well, you should assume that that's going to come with some type of cutting of rates, given the environment is generally pretty restrictive right now.
Well, they better not get cut as much as they raised. I mean, we can't go back to a period where they're at 1% again, but something less than this would be probably pretty normal. In fact, even right now, we're probably pretty normal rates. So it shouldn't hurt companies too much. Although, like you said, they got used to and they gobbled up as much debt as they could over the last few years.
Yes.
Okay, let's turn our topic to quits. I quit. You quit.
Oh.
Neither of us quit.
No,
but people are quitting less. This is a good thing. So this is a chart for the last 10 years of the number of people who are quitting, people who are voluntarily leaving. It's normally been a bad sign when people quit or potentially a good sign depending how you look at it, because they think that there's lots of jobs out there. They want to get more leverage. They can find another company that pays them more. This has eased in July. It's now back to pre-pandemic levels. And so this is good from a tightening of the labor market. We've all said that inflation, one of the big reasons we've had it is there were so many jobs there. And I'm going to also go to a second chart here in a second, which is job openings, the JOLTS data. Job openings at one point peaked at 12 million jobs that were available, 6 million people unemployed. Now that number is down to about 8.8 million people, or 8.8 million jobs, and about 6 million people unemployed. So when you've got that spread coming down, that's good because it means the worker doesn't have all the leverage anymore. It means companies don't have to make these gigantic wage increases for their employees. And hopefully that means that inflation will come down, because that's something that the Fed really can't do much control with, other than try to get people either fired or hope people come back to the market.
Yeah. Yeah, it's crazy to see the numbers, the quits, the US quits, total non-farm is how they look at it. Low was 2 million in April 2020. Makes sense. Everyone thought that they had a job, they absolutely had to keep it. Jumped as far as you're showing there, 4.5 million, man, in November of 2021, and it says dropped to just around 3.5 million. So yeah, to your point, that's good. And I don't know what the numbers say, but clearly, probably still to some point right now, quitters are also getting paid to quit. There were signing bonuses for all these types of people. So even if you weren't looking at a promotion and you were looking at a lateral move, you were still getting a signing bonus for making that lateral move. And I know a fair number of people who took advantage of that, even geographically, and just said, you know what, over the next couple of years, I'm going to jump. And I actually had a conversation with one of those people 2 or so weeks ago. And now they're kind of like, I don't know if I'm going to show the last 3 years of employment for myself because I had 4 jobs in 3 years.
Well, gone are the days where you stayed somewhere for 25, 30 years, and it doesn't seem like employers really care that you're switching jobs, although I look at it as a negative when someone's got that many jobs in their resume.
Yeah. You don't like jumping ship left and right. No.
I do have one more chart about jobs that sort of ties it all together. And this came out in the jobs report at the beginning of September. The jobs number that was announced was a decent number, about 187,000 new payrolls were added, although they did reduce the last few months significantly. That 187 is about double what a normal job number should be. But interestingly enough, I was reading about it. A chief economist at a company was saying that there's several categories that he's calling backfilling sectors. And he's saying things like retail, food services, healthcare are backfilling services because they were most affected by the pandemic. You know, you had a lot of people leaving those areas. And so they're the ones that have to still hire to get back to normal levels. And so he was making the point that about a third of total employment is in these sectors. But in the last 3 months, 70% of the jobs have basically been filled by people coming back into these sectors. So I think you have an interesting stat there that while the jobs numbers are decent, maybe it's all just making it up from where they were a few years ago. And obviously the numbers are coming down. And maybe it's not as great as we think it is in terms of number of jobs month after month.
Yeah, this is man, the gentleman at GMO, I'm forgetting his name, but the perma bear was speaking. Yeah, Grantham, exactly. He was speaking to stuff like this. Again, just trying to help his case that it's all coming apart in any given day. That basically the good job market wasn't as good as you think it is. If you look under the hood, it's pretty terrible. But again, anecdotally, look at margins, look at spending. Yes, credit card debt is higher. That's what happens. Debt gets higher. The reality is interest payments have not flown through the roof, and that's just a reality. It's funny, I didn't realize how much we both picked kind of job or labor stuff in our charts. But before I go right back into labor, let's look at this, the era of low rates. So this chart here is basically just pointing to the fact that S&P 500 companies are still benefiting from the era of low rates. And what this group did was basically look across all those companies, all the different debt walls that they have or different maturities that these companies have, to come with a basic idea of where they think an average interest rate is that these companies are paying. And if you look at it there, it's between 1.7 to 3.1% as of Q2 of 2023. That's pretty nice.
Yeah. I mean, yeah, it's not going to get much, not going to get any lower, right? It's only going to go up over time. But it's going to take a while before it gets there. So no one needs to panic.
So that exactly. So that's kind of the point. This isn't to say is it going to go lower or higher. Let's just assume it's going to go higher, right? Because of what's happened over the past 10 years. I think what you just hit on is the most important point. It's not going to go from 1.7 to 3.1 to 10.5 to 12.2. This will be a slow grind higher that very thoughtful leadership at companies will now have an opportunity to plan for. So they took advantage. They're still well positioned. The other reality is, and I think this makes sense, it's hard when you're a person living a life, business owners that run small businesses or even large mid-sized businesses, right? But they're not publicly traded companies in the S&P 500, right? So when you hear their stories about having trouble getting warehouse space over here because the rates are ridiculous, or having to refinance some 5-year debt that's coming due in early 2024, that makes a difference without a doubt. But when you're talking about these large publicly traded companies who have a ton of this pricing power and leadership that's looking beyond any horizon that you and I could ever look at, this is the type of leverage that they have. And this is why allocating to an asset class like this can be so advantageous over time.
Well, we've talked before, this is a double-edged sword because there are companies have loved the last 15 years, be able to borrow at such low rates. Your savers, our clients, investors who've had money sitting in cash, have hated it. Now it's the reverse. Now, if you're a saver, you love where interest rates have been. And now if you're someone who has debt, you hate the fact that you can't get the rates that you got 10 years ago. So there's always a winner and a loser in this situation.
Yeah, there is. But if you believe in risk premia, meaning what is the amount you need to be paid in order to take on a risk, well, guess what? It's on top of whatever the risk-free rate is. So if the risk-free rate is 5, your expectation for equity returns or stock returns is going to be higher than that. There you go. So back to jobs, because apparently that's the theme of today. This chart surprised me a ton. I don't think I can't really recall ever seeing something like this. So this is a labor efficiency chart that shows from 1986 to, I guess, the beginning of 23 or end of 22, what the ratio is between millions of dollars in revenue divided by the workers in all of the companies in the S&P 500. It's obviously dynamic, but Brett, I look at this, man, and I'm like, look at 1986 to 08. Wow. Efficiency gains completely stopped after the GFC. And ZIRP, what does ZIRP stand for? The zero interest rate policy, which we're talking about here. Wow, this episode's coming together nicely. Wow, look at that.
But you're not implying that something changed after the GFC, ZIRP. Like I'm not sure if anyone.
Wait, what are you talking about? A lot changed after the GFC. Let's not talk about regulation, but that zero interest rate policy did not exist pre-GFC.
Of course, but you're telling me that's the reason why, if they eliminated the zero interest rate policy, that you'd have the continual rise up of efficiency?
I have no idea, Horowitz.
There's lots of factors in there.
I'm not saying it's causative, but it's definitely
right. That's my point.
Correlation, right? Like it's just it's there. It is. And what I want to bring, and I wish I had an artificial intelligence maximalist that I could pop into the screen right now. You want some productivity gains? Go spend $20 a month on ChatGPT. It'll write all your emails for you. There you go. Productivity gains, Horowitz.
Just don't take our jobs.
So I'm glad you said it, because I was going to have to say it. So how about this? And again, this is the classic, the technology is going to make everything terrible. All the jobs go away. Have you ever heard of a prompt engineer? Well, that's because it's a new job created by AI, buddy.
An engineer on time. It's prompt engineer.
Oh, nice. Thank you. A prompt engineer, Mr. Horowitz, that makes well into the 6 figures are engineers hired by any type of company. These are tech companies or just any company that's trying to use these artificial intelligence powered LLMs, large language models, to be better users of that. Functionally, have you ever used ChatGPT?
No. I know you use it a lot, but I've never tried it.
The real problem, buddy. It's a real problem. So anyways, it's functionally an advanced Google where you give it a prompt and then it provides you a response. That response is basically the machine guessing what it thinks you want the next words to be based off your prompt. right? So that's what it's doing. It's guessing the best
It does
next
it in
word.
text message now. I mean, text message, it tells you what you might want to be saying next.
Yeah, but
Finish.
this is on steroid because it's combing the entire spectrum of all human knowledge available on the internet, which is kind of interesting. So, have you heard of a Boolean operator? Do you remember that from back in when Google first became a thing? So basically, words you can introduce into a prompt into Yahoo or Ask Jeeves or Google to get better results. So this is like that on steroids, where these prompt engineers are basically linguists, professional linguists, that will teach you, coach you, and or just do it for you. Basically, prompt these LLMs better than you can, so you can get better outputs from the LLMs. And that is now a high paid, skilled labor, of course, job that exists now that did not exist before this was a reality.
But I just want to say I write all my own emails. I don't use ChatGPT, but
Sure.
I do hope that AI is the next wave to lead the efficiency rising, because that's a problem, that we don't have the efficiency and you have the same amount of workers or less workers with less efficiency.
Yeah. Anyway, so yeah, and I'm not by no stretch of the imagination my AI maximizing here. It's just a reality. This chart was surprising to me how that productivity stopped. People are pointing to productivity gains for large companies relative to the technology offered and the productivity gains offered by this new tech and software. Hopefully it comes to pass. It sounds like, depending who you talk to, it might be faster to show up than other things. We'll see how disruptive it is, and hopefully it's productive from a margins perspective.
Well, I can tell you what was not productive. I brought a dog into the office on Friday. For an hour and a half, he ran around. Nobody did any work. It was a wonderful thing to watch him entertain everybody. But on some sad news on the Horowitz household, I want to end the episode by thanking Mr. Jackson, who has been in our lives the last 16 years. He was our family dog, and he had an amazing dog, because when he was first brought out from the Humane Society, when I got adopted him, he figured out a way to escape from his crate, figured out a way to escape from the front door, run down the hallway, find anybody who was around. He bumped into a woman who had a dog. That dog became his best friend and his brother for 14 years. That woman became my wife, his mom. And so I appreciate Jax for everything he did. He had a great life, and we're sorry that he had to go.
That's the best. Goosebumps. Love you, Brett. Tough
Right.
loss.
Yep.
Good
I know you
dog.
know what that's like, but we'll be together someday, all of us.
The Jackson, episode 42,
Yep.
dedicated to Jackson Horowitz.
Thanks, Jackson.